Hello, I'm David Klotz, President of Precision Metal Forming Association. I'm pleased to welcome you to today's webinar on the new tax law and what it means for you. Today's Zoom session is being recorded and for archive purposes, so all participants are in listen-only mode. However, you do have the ability and encouraged to communicate anytime by submitting questions using the Q&A feature. We'll answer as many questions as possible at the end of the presentation. Following the webinar, all registered attendees will receive a copy of the archive recording as well as the presentation slides. I'm pleased to be joined today with Mike Devereaux and Omar Nashashibi. Mike is a partner at a PMA member company, Wipfli, and is a CPA and a certified manufacturing professional. He has identified millions of dollars in tax incentives for manufacturing clients, led hundreds of R&D tax credit study engagements, and demonstrated leadership and exceptional judgment in tax restructuring of various acquisitions. Omar is PMA's lobbyist and the founder of Inside Beltway. He has been representing PMA and our members in DC for more than 20 years. Thanks to the tireless efforts of Omar and the rest of our PMA advocacy team in Washington, and our members who met with their lawmakers, reapplied to our action alerts, and sent messages to their members of Congress, we secured one of the most significant legislative victories in years. Permanent pro-growth tax policies and long overdue certainty of businesses of all sizes. This win puts hundreds of thousands of dollars, if not millions, back into the pockets of every PMA member, and it would not have happened without your voice and PMA having a seat at the table. Before I turn it over to Mike and Omar, I want to give a quick overview of PMA's advocacy work. Through our One Voice advocacy partnership with National Tooling and Machining Association, we lobby for policies that ensure a strong U.S. manufacturing sector. Our lobby firm, Inside Beltway, and our strategic communication firm, the Policy Resolution Group at Bracewell, work daily in D.C. on behalf of our members, focusing on the issues that matter most to you. The top issues from our January survey of members were taxes, healthcare, workforce recruitment, and training, and trade and tariffs. We've had many victories over the last year, just a few of which are highlighted here. We've succeeded in defeating the Labor Department rule that would have eliminated competency-based registered apprenticeships, created a process to cover downstream products if tariffs were imposed on steel and aluminum, and testified last month at OSHA's hearing on its proposed heat rule. And most notably, the reason we are hosting the webinar today, the tax bill President Trump signed into law on July 4th. This was PMA's #1 lobby priority and the main area of focus during our fly-in DC in April. The new law includes virtually every priority we sought, including restoring 100% bonus appreciation, allowing full and immediate R&D expensing, making permanent the 20% Section 199A pass-through deductions, and much more. With that, I'll turn it over to Mike Devereaux from Wipfli to dive into the law and how it can help your business. Welcome, Mike.
Thanks, David. Appreciate it very much. Omar, great to see you again. Before I dive into the one big, beautiful bill, I thought I'd share this slide. I know a lot of you all know Omar. You've heard him speak. He's been working with you all for a long time, but some of you might be new to Wipfli. And so I just kind of wanted to share a little bit who Wipfli is. We're a top 25 CPA firm, but we do all sorts of things. My partner, Laurie Harbour, is fortunate to serve with David and Omar and work on the board. And just happy to be a partner here with PMA. So how about the one big, beautiful bill? Technically, but budget reconciliation bill that went through. This was quite a quick timeline from my perspective. Sure would want to hear your thoughts, Omar, on your perspective and how this came about.
Oh, it was. The president said go, and Congress went. This happened quickly. Many of us thought that we'd have the Senate vote, House vote sometime actually this week, heading into the final stretch. But the president wanted a signature by July 4th, and he got that. He got that celebration. This thing moved very quickly, so quickly that even some members didn't understand fully what was in there. They might look at some changes. But what was key here is we started our advocacy lobbying efforts last summer, with PMA having meetings during some of the House working group sessions going into the fall, and then following the election, having a better sense of where we would go. We arranged for our meetings for PMA with the House Ways and Means Committee. Mike, that you were on, we had that call back in April talking about expanding that 199A and making it permanent. And then the other challenges that we had going forward, the will they or won't they. We set up meetings at the White House, back in person here in Washington during the fly-in. So really around Memorial Day, that's when we got the message from the White House that the president wanted this done. And that's when they really moved forward, and why the House had to accept a lot of the changes that the Senate made. When we look at this, Mike, the end work product came out similar to what we saw from the House Ways and Means Committee, where we were working. The Senate really undid much of what the House did on the floor. And that's why we got a lot of what we wanted here. And more importantly, we got some permanency and some stability.
Yeah, I couldn't agree more. I was extremely pleased, and just frankly, it's really favorable for the manufacturing sector. If you look at it from a theme perspective, manufacturing's a winner here.
Yeah, I'd agree. And lastly, from my end, is I look at the Tax Cuts and Jobs Act, that 2017 bill from Trump, really is a tax cut bill. This is a manufacturing investment law, and that's where we're seeing that stability, these tax provisions on bonus, on R&D, others being made permanent. This is the first time in generations that you can go almost toe to toe with the Europeans and the China and others that are really providing these incentives for domestic manufacturing that we just didn't have here. And this is something that's going to be a lot different in changing the landscape for businesses.
Yeah, it is. So let's dig into the one big beautiful bill, or you might hear it called as OBBB or OB3, just depending upon the acronym we're using these days. And so as Omar mentioned, a lot of this was extension of the Tax Cuts and Jobs Act, and then a whole lot of additional investment related to the credits and so forth. And so we really need to dive into it. You look at it from two different perspectives. One is the individual tax rates, and the other cuts that were part of the Tax Cuts and Jobs Act. And then there was a whole slew of different campaign promises. And so what's important to this group here is really some of the things that I've highlighted here. So of course the individual tax rates were of relief, and continuing that top rate is not 39.6%, which is what it was scheduled to revert back to at the end of this year. We got some estate tax relief. The Section 199A deduction, that's the flow-through qualified business income deduction, the 20% flow-through for you companies that are organized as S corporations or partnerships on the call. This SALT deduction was really a moving target all throughout the negotiation. And the way it ended is they didn't make it permanent, but they increased the cap to $40,000. So as an individual, your maximum amount you can deduct for state and local taxes is now $40,000, but that starts to phase out at $500,000 of adjusted taxable income. So once your adjusted gross income exceeds $500,000, between $500,000 and $600,000, it phases out at 30% rate down to $10,000. You're not going to get below $10,000, so it's going to fall somewhere in between $10,000 and $40,000. One thing that we were concerned about was a number of states had enacted pass-through entity tax elections. So if I'm an S corporation, I could elect to pay my state taxes at that entity level and then allow it to be essentially deductible. And it was a way to get around the $10,000 cap. And that remained unchanged. And so thanks to the lobbying efforts from Omar and his team, some of these things really kind of allowed us to continue to do some of the planning that kept some of your federal income tax liabilities lower. We, of course, saw a higher standard deduction get maintained there. And there's even a senior deduction in addition to that for those taxpayers over the age of 65. But these next set is really the pre-cliffs. These are the things that already started to impact you beginning back in 2022 with both the interest expense limitations. If your average annual sales over $31 million, that started at 25 million, but was indexed for inflation. You've already had to start capitalizing your R&D expenditures, and you had to do that from 22, 23, and 24. And all this is made permanent, and they fixed them retroactively. So with Section 174, I'll get into some more detail here on the R&D side, but they got a retroactive fix. We got 100% bonus depreciation back to January 20th of earlier this year. So you're stuck with the 40% bonus depreciation up for the first 19 days of the year, but those that are placed in service and acquired, there's a special definition that I'll touch on later on, then you're eligible for that 100% bonus depreciation. The interest expense limitation also was retroactive earlier this year to January 1st. For you international companies on the line, we saw some changes with the international tax rates as well, and the ability to deduct some of the foreign derived income and so forth. And we saw some extensions there. But in addition to the Tax Cuts and Jobs Act, we saw some campaign promises make their way into this budget reconciliation bill. First two probably got the most press in the mainstream media, with the no tax on tips and the no tax on overtime. The reason I think that's important to you on the no tax on overtime is now you've got a new reporting requirement. Form W-2 is surely going to be changed to be able to report not only taxable tips, but tip income and overtime. There's going to be there's a specific rule as to what overtime is. It's just that when you pay an employee time and a half for working over 40 hours, it's that half. So if somebody works 50 hours, you've got 10 hours at their rate. So let's just assume that somebody's making $20 an hour, and then anything over $40 an hour, they're getting 30. It's that 10. It's that $10 difference. You're going to have to report that out on your W-2s. And the law is retroactive to earlier this year. And so that's going to be important to be able to go back and either work with your payroll provider or your team in-house to be able to account for the overtime that your employees have been working throughout this year and for the remainder of the year. The other thing I want to draw attention to is this new factory write-off. 100% write-off of a factory that's used in a manufacturing setting. If I'm using the building in manufacturing or production, there's 100% write-off. And I've got a couple of slides on that, so I'm going to save the details here until we get there. To pay for some of these things, we had some revenue offsets. Probably the most impactful to this group would be the Inflation Reduction Act energy credit rollbacks. And I recognize that didn't impact a lot of you, but I do want to cover some of those things, and I'll dive into the provisions that I think are going to be impactful to your businesses. So let's dive into what does it mean for manufacturing, right? Because I think that there are some specific provisions. Earlier on the call, I mentioned that manufacturing was a winner here as it relates to the One Big Beautiful Bill and the provisions associated with it. And this has to be the biggest, right? And this has to be probably the most impactful. Just to give you a little bit of background, this in the media and so forth, it's referenced as the R&D credit fix, and it's really an expense issue. There's actually two different concepts at play with respect to R&D. There's the R&D tax credit, which is Code Section 41, and there's R&D expenditures, which are Code Section 174. You've been able to deduct research expenditures under Code Section 174 as they're paid or incurred since 1954. And then when they passed the Tax Cuts and Jobs Act, the intention there was to get some dollars with respect to the pay for, because they used budget reconciliation at that time and we're trying to stay budget neutral here. And what they did is they raised taxes through the R&D side. I'm sure you've heard Omar speak about this in the past. You had to capitalize your R&D research expenditures beginning in tax year 22. We didn't think that was going to see the light of day. In fact, we thought between 2018 and 2022 that was going to be fixed, but it got caught up in some political scuffles within DC, and it didn't. But thanks to the lobbying efforts of the PMA and Omar and his team, this was fixed, and it was fixed retroactively. So beginning in tax year 2025 and thereafter, you're able to deduct your research expenditures as they're paid or incurred for the domestic side of it. Foreign research expenditures are still required to be capitalized and amortized over a 15-year period. And it's going to be very important as to where is the research taking place. Is it happening in the United States, or is it happening outside the United States? And where are those supplies and materials and wage expenditures being incurred? And and really kind of differentiate that. You've had to differentiate that in the past because foreign research didn't qualify for the tax credit under Section 41. But here under Section 174, you really have to differentiate it because it's a meaningful difference now. Because in 2025 and thereafter, domestic R&D is deductible. Foreign research has to be capitalized and amortized over a 15-year period. Now, let's talk about the retroactive nature of the R&D fix, right? As I mentioned, it was fixed retroactive, and the way that you go about that is for every company can catch up all of their unamortized research expenditures. And so let's say I capitalized $1 million of research expenditures in tax years 22, 23, and 24, and I started to take my amortization deductions. Any unamortized amounts at the end of 2024, I will get as a deduction in either 2025, or I'm allowed to spread that over 2 years, 2025 and 2026. Now, in the event that your average annual sales are less than $31 million, defined as a small taxpayer, you're allowed to amend your returns for 22, 23, and 24 in lieu of doing the catch-up calculation that I just described. And so if your average annual sales for tax years 22, because it's determined based on 25, and you look at the prior 3 years, if your average annual sales for 22 through 24 is less than $31 million, you will be allowed to make an election to go back and amend your returns, and those amounts that you paid in excess that you otherwise would have from deducting your research expenditures now could be claimed in a refund on your amended tax returns. Now, I've got this bullet point here of Section 448 rules apply. And I'm sorry to get in a little geeky on you on the tax codes. I already brought up Section 41 and 174, but here's another code section for you. But really, what I want to explain here is you can't have tax shelters. And you might say, well, Mike, I'm not a tax shelter. I'm a manufacturing company. Well, the way that the rules read, in the event that I'm a flow-through entity, I'm a partnership or an S corporation, and more than 35% of my ownership is passive, then I'm deemed to be a tax shelter for purposes of the Section 448 rules, and I won't get the retroactive treatment. I will just have to catch everything up in the years, catch up everything in 2025 or 25 and 26. Okay, let's talk about capital expenditures. Sorry about if you guys see those Teams message. I'm sorry, I've done that. I've turned it off multiple times. So if you see the Teams message, I apologize. Machinery, equipment, and plant. We've got 3 different areas that were changed with respect to your capital investments. The first we talked about earlier on, it's the 100% bonus depreciation. And that's for anything after Trump was inauguration. Inauguration day was January 20th. And that anything placed in service and acquired after that date can be eligible. So the first 19 days of the year, you have 40% bonus depreciation. For the remainder of the year, you have 100% bonus depreciation. However, they did put a written binding contract rule for determining acquisition date. So in the event that maybe I purchased a piece of equipment last December, right? And now it's sitting on, it came on a boat and I placed it in service after January 20th. That does not qualify for the 100% bonus depreciation because I had a written binding contract to buy that piece of equipment. So just a little wrinkle there on the bonus depreciation, but otherwise very, very favorable provision for the manufacturing community that's investing in capital equipment on a regular basis. Another provision that deals with capital equipment is Section 179. You know, when I first started in public accounting, the Section 179 limits were $16,000. That was the maximum amount you could deduct as a research expenditure. Maybe that's showing my age a little bit, but or I think it's more reflecting of this provision being used by Congress to incentivize more capital expenditures. And so they increased the amounts to $2.5 million. Now, this is only for companies that are placing in, it's meant for smaller taxpayers. And it starts to phase out once your eligible expenditures exceed a certain amount. And that phase out amount starts now at $4 million. And it's a dollar for dollar phase out. So once I exceed $6.5 million in capital asset purchases that qualify under Section 179, I don't get the deduction anymore. I don't get the write-off. Perhaps that asset could qualify under 100% bonus depreciation. Perhaps not. Because I often get asked the question, well, Mike, if I got 100% bonus depreciation, why do I even need Section 179? Or Mike, I don't buy more than $2.5 million in assets a year. Why do I need the bonus depreciation? I can just take it under Section 179. Well, not every asset falls in a class that's eligible. For instance, there are some things that qualify for Section 179. Like, let's say you put on a new roof on your building. Let's say you put in a new HVAC system or a new alarm or security system. Those are all Section 179 eligible, but they're 39-year property. And 39-year property doesn't qualify for bonus depreciation. And so I think it's important to be thinking about from a planning perspective, what assets do I want under bonus? What assets could possibly qualify under Section 179? And these higher amounts reflect the ability to write off more assets when they're placed in service. It applies to everything placed in service after December 31st of 24. So this entire year, you got a retroactive fix And these amounts of 2.5 million and $4 million are indexed for inflation. So they're going to increase each year with inflation. Okay, we've got a whole new provision, and that's the factory write-off provision here. And we're going to start with the definition of qualified production property. So it's a new tax incentive that rewards companies for building manufacturing facilities, manufacturing or production facilities. And the way that it works is you get 100% write-off of your qualified production property. Now, qualified production property only relates to the manufacturing area. So if I go build a manufacturing plant, there's still a need to kind of segregate out the different portions of the building. For instances, the offices or administrative services or parking or sales and engineering areas, those aren't eligible for the 100% write-off or first year depreciation, right? It's only those areas. I got the question earlier this week on warehouses and whether or not that would be qualified. And that's not directly used in a manufacturing or production activity. So my gut tells me that Treasury Department, when they issue rules and they issue guidance around this, that warehouses may not qualify. But I want us to wait and see. You know, it could be directly attributable to this. So there's some things that are just going to have to be worked out when when Treasury issues guidance around this issue, which they inevitably will do. There were 82 times in the One Big Beautiful Bill that the words the Treasury Department shall prescribe regulations. The Treasury Secretary shall issue guidance, whatever the case is. So Treasury, the administrative branch of the government, is going to get to weigh in on some of these incentives. And so having an understanding of those rules is going to be very important. So I mentioned earlier that this is for manufacturing, right? So the qualified production property, it has to be used in a manufacturing environment. It has to be integral to the manufacturing or production activity. The original use has to be commences with the taxpayer. There's an exception to that if you retrofit a building. Again, we're going to need some guidance on this, but there could be ability to retrofit a building that wasn't used in production or manufacturing towards that manufacturing use. There's the potential for that to qualify. It's only for facilities that the construction begins after Trump was inaugurated, January 19th, 2025, and before 2029. So it has to begin in 28 or earlier. The property has to be actually placed in service when I start to use the property after the 4th of July, when this bill was signed into law, and before 2031. And so there's some very specific rules as to what portion can qualify. It's got to be substantial transformation. You know, knowing the companies on this line, knowing the companies that are participating in the webinar, you're manufacturing. This is not going to be a hurdle for you. Now, I want to point out a couple of wrinkles. In the event that you're electing to use or required to use the alternative depreciation system, let's say you're financing the building with tax-exempt bonds. Well, in that case, you're not eligible to use the maker's method of depreciation for depreciating that building. You're required to use the ADS method, and therefore it wouldn't be eligible. So that's going to go into your math as to how you're going about financing your buildings should you decide to go and build a manufacturing plant. And in the event that over a 10-year period after you place it in service, it is not used in the production of qualified property, it's not used in manufacturing, then there's a recapture provision related to that that can sting people. And I'm sure there's going to be quite a bit of guidance around that issue and what the rules are associated with timing of that recapture. Now, earlier I was talking about some exceptions if you're under the $31 million threshold. This is for taxpayers that are over the $31 million threshold, because if you're under 31 million, you're not subject to this limitation. But essentially, because of the Tax Cuts and Jobs Act of 2017, you've had this new limitation on your ability to deduct interest expense. And so you have to look at your business interest income plus 30% of your adjusted taxable income. Floor plan financing interest isn't relevant here. That's mostly car dealerships and other types of dealerships that have floor plan financing. But essentially, it's your interest expense. It's 30% of your taxable income plus your business income. You get to net the two. And that is your calculation. So what is adjusted taxable income? That's the crux of the change. Is this provision did not go away. Interest expenses are still limited, for companies over $31 million of average annual sales. However, it's now based on EBITDA instead of EBIT. Why is that important to you all? Well, because you're buying pieces of equipment and you're probably claiming things like bonus depreciation and other large depreciation amounts that I'll now get to add back to my taxable income before taking that number times 30% to arrive at whatever that limitation is. Now, any unused interest expense can be carried forward indefinitely. Similar to like a net operating loss would be carried forward. But that interest expense still can be limited and can sting some taxpayers that are highly leveraged. So I know a number of you on the line here are S corporations and partnerships, and there's a number of provisions that are directly related to individual taxation that impacts you as owners of a manufacturing company. The tax rates, the increased standard deduction, the personal exemptions, all of these things that have an impact. I want to touch on this third one or this fourth one here. The permanent increase of the alternative minimum tax exemption amounts. Now, there are two different tax systems in this country. You pay the greater of the two. You have the regular income tax and you have the alternative minimum tax. And so one thing that is a wrinkle with the alternative minimum tax, as a general rule, the R&D tax credit does not offset the AMT. There are exceptions to that rule. For instance, if I generate more credits in a year that I have tax attributable to that entity, then perhaps the carry back or carry forward characteristics of those credits would allow you to offset the AMT. However, the general rule is you can't utilize these R&D credits. And I've had clients that, they generate tens of, not hundreds of thousands of dollars of R&D tax credits, and they couldn't use them because of the AMT. Well, these higher exemption amounts and higher phase out of the exemption amounts is really, really important to you for you all to be able to utilize the credits that Congress intended you to be eligible for. In addition, we talked about the 199A deduction. That essentially brings your effective rate down from 37% down to 29.6%. And so I've started to have some conversations with our clients around type of entity. They've now kept this at 29.6. If that was going to revert back, a couple of my clients were thinking about C corporation, right? Because of that 21% rate. And that was remained untouched. That's still that 21% rate. I touched upon the SALT cap earlier here. But just to kind of reiterate, once my adjusted gross income exceeds $500,000, I have to start to phase that out, and it could revert back, and it could phase down all the way down to $10,000 maximum amount of state and local taxes. But in the event that you're in a state that has that pass-through entity tax election, I'd really encourage you to investigate it and look into it because it could save you some dollars. Because the raising it to $40,000 is great, but if I'm a S corporation and I'm a stamper that made $1 million and I didn't take the $1 million and I just reinvested into the company, I'm still having to pay tax on that $1 million of income. I'm above the threshold amounts. I'm only deducting $10,000. So I think it's important. Hey, look, you should be looking at these pass-through entity taxes. There's about 35 or 36 states that have pass-through entity tax elections that are open and able to be utilized as a planning tool. Oh, we got some permanency under the estate and gift tax provisions. I talked to a number of attorneys, estate planning attorneys that are just busier and can be because we had a lot of changes that were scheduled to change here at the end of this year. And we got some nice relief here from the Senate on the state and lifetime exemptions at $15 million a person. Of course, $30 million if it's a couple, and they're indexed for inflation and made permanent. So some nice relief there. I mentioned earlier that they paid for a lot of these tax cuts through tax increases or changes to the Inflation Reduction Act energy credits. And this first one, I think, is the most relevant. And it got bundled up and tied into this whole thing because it was enhanced as part of the inflation, it was enhanced as part of the Inflation Reduction Act. So 179D, the energy efficient building deduction, has been around since 2005. It was signed into law by President George W. Bush. during his administration. And what that was is originally it was 60 cents per square foot for accelerated depreciation for energy efficient lighting or energy efficient HVAC or energy efficient building envelope, which is your roof and your exterior walls and so forth. And if those were energy efficient compared to some ASHRAE standards, then you were entitled to accelerated depreciation up to 60 cents per category for a total of $1.80. Well, what happened is in the Inflation Reduction Act, that number jumped all the way up to $5 per square foot, and it was kind of lumped in as part of these energy credits that were all rolled back under this bill. And so if you're putting into service any of these energy efficient lighting or energy efficient HVAC, or maybe you're putting a new roof on, if it's going to be energy efficient, you want to qualify for this, the construction needs to begin before June 30th of next year, about a year after little under a year from when the bill became law. If you're putting charging stations in, that would also be relevant. If you put any electric vehicle charging stations in, or you plan to, that would certainly be eligible. Same thing with the solar. If you're thinking about putting solar panels on your building or on your facility, then there's could be a sense of urgency there. There's some other provisions impacting manufacturers, and they're not all listed here. There's a number of things that I know Omar and his team worked very, very closely with members of Congress in obtaining for these, but these are just some things that I think are going to impact manufacturers. I'll kind of touch on them one by one. I mentioned if you're an international company, a multinational company, you had some changes to the regime in which you deduct a portion of your income associated with those entities and your controlled foreign corporations. And so we're still unpacking a lot of those changes. The entire regime has changed slightly. And again, that's going to be one of those things that I think Treasury Department's going to issue some guidance on. There are the new reporting requirements. It's up to $25,000 for a married couple is eligible for the overtime deduction. Then there's this qualified small business stock provision. And this was pretty interesting here. It expands the qualified business exclusion. And qualified small business, there's a whole number of different provisions. But essentially what it allows you to do is if you're a C corporation and you sell your stock, I can avoid up to $10 million of gain on the sale of that stock. And so closely held companies, and there's a number of provisions. I've got to have less than $50 million of assets and so forth. Well, they expanded the gain exclusion from 10 million to 15 million, and they also modified the holding period. Before I had to hold the stock for a 5-year period, but now they started to phase in some of the benefits for if you hold the stock in 3 or 4 and even 5-year periods as well. And so it really kind of begs the question, if I'm starting a new company, maybe I want to be a C corporation if I plan on selling the stock later on, because it's only for stock. These new changes are only for stock that are acquired after the 4th of July. But it could be a provision if you're thinking about starting a new business or maybe building another business on top of your business. This is something that might be worthwhile to look into. This other provision, it kind of flew under the radar for a number of years, but it was a pretty big revenue raiser as part of the Tax Cuts and Jobs Act. It introduced this new code section 461L, that they've now made permanent, and it modified some of the carry forward rules. If you're an S corporation or a partnership and you're throwing off an ordinary loss as part of your business. So if let's say the company from a taxable perspective lost $700,000 and I own 100% of the S corporation, that $700,000 loss comes out on my Schedule K-1, I'm not able to deduct all of it, even if I have basis and I'm at risk for the loss. So as a result of that, I'm capped at $500,000. So I can deduct $500,000. The $200,000 before this change would just carry forward as a net operating loss. I'd get it on next year's return. But now it's going to be limited to that entity that gave rise to the loss to begin with. I can't just use it as a net operating loss. I've got to start matching those losses to the income of those entities. And so that was a significant change. In addition, caught some people off guard because they're surprises. It's a $500,000 cap, right? And you're not going to be able to utilize that even if I'm at risk and put the money into my business here. Okay, what did not make the bill? We had a 15% C corporation rate that was talked about and bantered about. It was talked about on the campaign trail, and didn't make it into the bill. We saw the House version increase the Section 199 rate, but as Omar mentioned earlier, you know, they were kind of forced to take that Senate version of the bill, which kept it at 20%. But what it did is it made it permanent. And so we got a permanent 20% 199A deduction, but not that 23%. And then in addition, there's this threshold. You guys have heard me say $31 million a number of times on this call today. There was discussion around whether or not to increase that to 100 million. In fact, I think it made it into one of the House versions of the House versions of the bill that would allow you to use things like the cash basis of accounting or avoid the unicap rules if I'm under that 100 million. That did not make it into the bill. That's still 31 million. But I think it brings up a point that I want to make here. If you're under that 31 million and you haven't looked at your methods of accounting since 2018, it might be something to look at, right? I could be on the cash basis of accounting for tax purposes. And there's no requirement for my book, my financial statements that I give to my shareholders, that I give to my bank, that says that that has to be on the cash basis. So I continue to operate my business on the accrual method of accounting. So I make a part, I ship the part, I bill the customer. Once I bill the customer, that's revenue to me. I recognize that as revenue. I've accrued the revenue. I don't have the cash yet, but I've accrued the revenue. On the flip side, I pay an employee on December 26th. He works a couple of more days throughout the year. I accrue that payroll. I haven't paid him yet at the end of the year. I accrue that payroll. I accrue the payroll taxes associated with it. And I've got these accrued liabilities. Other things like customer deposits, that would also be lumped into some of the liabilities associated with that. But if you think about it at a high level and your receivables exceed your payables, then it's probably worthwhile to look at the cash method of accounting. I'm not saying you automatically do it, but it could be pretty significant. And let's say that I decide to change to the cash method of accounting. If I decide to change to the cash method of accounting, I get to act as if I'm on the cash method of accounting throughout the entire tax year, but I get to catch up that difference. And so at the end of, let's say I was thinking about changing my method of accounting here for tax year 2025, and I looked at my balance sheet in 2024, and my receivables were 3 million, and my payables were 1.2 million. Well, that difference, that $1.8 million, if I change my method of accounting, I get a $1.8 million deduction that year. That's a significant change in benefit. And is it permanent tax savings? No, but it's time value of money and can really save you some dollars here, especially in years where you've got some significant tax liabilities. Maybe you had some significant liabilities from the old R&D regime, right? And so it could be a nice way to think about changing it. Same thing with the uniform capitalization rules. It used to be that if I was over $1 million in sales, I had to be on the accrual method of accounting. Well, that number has obviously increased significantly, and the unicap rules, and I don't have to capitalize my overhead into my inventory anymore. And so that could be another method of accounting to start to think about. So let's talk about timing here for a minute. What are things that you should be doing right now? So things that you don't necessarily need to wait for guidance on, or time is of the essence. And that's planned capital equipment investments. Maybe there's some rules changes on respect to the factory provisions, but I can tell you right now, Section 179 and bonus depreciation, you start to thinking about those things. Now, am I saying to go out and spend money just for the sake of spending money and letting the tax tail wag the dog? I'm not. But if you've had some planned capital equipment investments, you can now feel more comfortable pulling the trigger knowing you're going to get the tax benefit from that investment. Energy projects. A number of these energy credits are expiring or have expired, and therefore time is of the essence to begin construction of this. Things like energy efficient lighting, solar panels on your roof, or geothermal energy. Those sort of projects, if you're thinking about them already or have them planned, make sure that you're in line with the requirements to start construction or placing them into service. Overtime reporting. Overtime reporting, I think, you're going to have to go back and look at your prior years, or excuse me, prior months, and determine what portion of the wages were subject to these overtime rules, so that you can properly report it once Form W-2 changes, and they get those revisions made. So what are some things that I'd say, hey, let's hit the brakes a little bit. These are really, really beneficial. But let's hit the brakes and let's let the Treasury Department issue some guidance here. And that's on the R&D amended returns. That's one of them right now. Because right now, if you said, Mike, hey, I want to go back and I amend, can you amend my returns for me, tax years 22, 23, and 24? I could say, yeah, we could, but I'd tell you to wait because oftentimes, especially with R&D, there's specific filing instructions. So for instance, if I a C corporation and I amend my return, there's a revenue ruling that requires me to file the amended return down in Ogden, Utah. So what I would say is let's not just jump into it and amend those returns. I think Congress, or excuse me, Treasury will be coming out with some guidance here soon. The estate planning, there's no longer this rush, right? Is it important to go and update your succession and your estate planning, perhaps your buy-sell agreements? Yes, it is, but there's no longer this cliff that we have at the end of the year, and therefore that sense of urgency has subsided a little bit here. The factory construction planning, right? So if I'm thinking about building a new building, something I think very important is who owns the building, right? And because there's some specific rules that if I'm a lessor of a building and the manufacturing is the lessee, then I don't qualify for the write-off. But it defines the rules as taxpayer. And if I'm a related party, then perhaps I could get the benefit. And I think Treasury is going to have to weigh in here because there's talk of syndicate being part of that taxpayer. But I really think that in order to make sure you're structuring it properly and making sure that the building is in an entity that A, I get the benefit, and B, I want it to. Generally speaking, as a general rule, there's exceptions, but generally speaking, I don't want real estate inside an S corporation. I'd much rather have it taxed as a partnership, being an LLC, and taxed as a partnership, as a general rule. Well, what if my operating company is the S corporation and my real estate company is an LLC taxed as a partnership? Do I get the break? I think that's yet to be seen. And then finally, if you're thinking about some of the opportunity zone investments, and though that's if you're thinking about building plants or buying plants in low-income communities, then there's some additional tax incentives associated with that. But the rules just changed and they modified that a little bit to expand upon the success they had when they originally put the opportunity zone funds in. So what can you be doing? Stay on top of what's happening, right? I mean, because PMA is going to continue to publish guidance and provide information to the membership. I just say pay attention because it's going to have an impact on your business and ultimately your tax liability. Start to think about forecasting some of these tax implications. What's this going to mean for cash flow? What's this going to mean for estimated tax payments, whether I'm making it as a C corporation or whether I'm making distributions to my ownership group so that they can make quarterly estimated payments? What does that change? How does this math change? And then monitor the tax issues and look out for incentives. I'll be speaking at Forming Our Future and looking at some of the tax benefits and tax incentives that I think most of the folks on this call should be thinking about and taking advantage of. And so we'll be able to unpack that a little bit more detail on some of the things as opposed to some of these new fun tax law updates that I'm sure we'll have guidance for before then. So with that, I'm going to go back to turn it over to you, David.
Thanks, Mike, and thanks, Omar. And Mike, thanks for all the information you provided. We do have some questions. One of them I think you've already addressed. I confirmed with that person, so I think that was addressed. But one question was just installing a new HVAC for a clean room electrical system or for expansion, new chiller system, or a new building within the building, new ceiling for a model room, qualify for QPP?
So I think that's a very creative way to describe the building within a building. But I think it's got to be a new facility. I think when Treasury issues the guidance here, it's going to have to be a new facility. What they're going to have to opine on some of the gray areas is what happens if I build a brand new facility right next to my existing facility, and
Right.
then maybe I connect them, or I don't connect them, or something along those lines. And I think we're going to need some guidance there. The new clean room, however, would be qualified improvement property and therefore be eligible for the bonus depreciation. the 100% bonus depreciation. So you may still get your write-off, but not under the new qualified production property provision of the factory write-off, because clean room is a general, if you're making improvements to the interior of your building, it's called qualified improvement property. And that's a short enough tax life that I can write that off under 100% bonus depreciation if I'm doing that. So you may get to the same result with without the ambiguity of the qualified production property and whether or not that fits.
Okay. Thanks. Thanks, Mike. Another question. You still have to balance bonus. You still have to balance bonus, the section 179 against using 199 as the first two reduce income applicable in such, correct?
So yes, you should model out the impact of section 179 on 199. So what section 199 allows you, 199A allows you to take 20% of my income associated with that. I would much rather get that 20% deduction if I've got other types of weighted, but yes, you're 100% right. You need to model the two to determine which is best.
Okay. Another question. When does the construction for energy efficient items need to happen before termination of the deduction?
Construction has to happen prior to June 30th of 2026 on the 179D provisions. There are other rules like the solar panels that have a different date, if I remember correctly, and I can't recall that date off the top of my head. But I can get that answer out to everybody if their question was around the solar panels. But if it's around the energy efficient building deduction, the HVAC, the building envelope, or the lighting, that's all June 30th
Okay.
next year.
Good information. Omar, anything to add from some of the things Mike mentioned?
Yeah, I think you hit on a lot of good things, and it's one of those where there's a number of provisions, like you said, it's green light go, where you really should be moving forward and starting to plan on some of these, whether it's that 179 being doubling and looking at the interactions. I think you're right. We are going to be looking at more guidance. We were in a meeting with the tax writing chairman last Monday, and he indicated that a good number of the rules from the IRS would be coming out here in August, and the next mid-August is what most in town are expecting. But this was a pretty significant bill that gives us a lot of that stability that we needed. And I think on the questions on 199A, understanding the interactions of those are also important. And to Mike's point, there's other provisions in here that we don't consider really just focused on manufacturing, but important for businesses, expansions of HSAs, looking at employer credits for employer-sponsored health insurance there. And then also on the workforce side, where we were able to expand section 5 or 529s, for example, to be able to apply them for industry recognized credentials and expenses related to those. For example, items and expenses related to PMA training could potentially be used for 529s if that individual decides to pivot from a four-year institution. Section 127 will allow employers now permanently to contribute up to $5,250 annually towards student loan payments without those counting towards income for that individual employee. So I encourage you to think of this in a number of tiers. Along the lines what Mike said, break it down for CapEx, looking at it from facility investments such as HVAC, but also production equipment investments, and then also on the employee, but then pivot it. What are the employees seeking to benefit from this, whether it's overtime and otherwise? So I think there's a lot to be looked at here, and especially when we go back to this uncertainty over tariffs, there might bring some opportunities here through this new tax law.
Thanks, Omar. Mike, anything to wrap up? Any final thoughts?
No, I appreciate the opportunity. If anybody has any questions or have things that maybe they didn't want to put in the chat because it's a little sensitive, being a tax issue, I'm happy to be a resource for you and answer any questions anyone has.
Yeah, and I appreciate you taking the time and Omar today. And we did answer all the questions that are out there. And I think that also, hats off to Omar and our DC team for everything we did. And we had a great fly-in this year, as I mentioned in my opening comments. And we got in front of the Ways and Means Committee and went to the White House talk about tariffs. So we're making an impact, and we have a government affairs committee. Some of you are not aware, we have a government affairs committee that we do it with NTMA. And again, we're always focusing on the issues that are affecting our members and that are in the manufacturing sector. And so we're out there for you. So just want to, anytime there's any questions that come up, feel free to reach out to myself or Chrissy Camagiano. And then again, you've got contacts here of Omar and Mike if you want to do something directly. As Mike mentioned, he is going to be speaking at FOF, Forming the Future annual meeting in March at one of the breakout sessions. He'll also be on stage with Lori on Friday as well in the morning. So just want to let everyone know a follow-up email will be sent soon after with the link with the recording, and the presentation slides will be available. And if you'd like to hear more from Omar and our DC team on the latest policy developments in DC, and you should attend our One Voice webinar this Friday, August 1st, and you can register for it on PMA's website. So that concludes today's webinar. I hope everyone has a good rest of the week, and thank you for attending. And also, thank you for being a PMA member.